Hey everyone, despite SoFi stock price falling after the earnings release, there was some really good news for SoFi stock investors within the earnings release, and I'm going to share those with you in this video. So let's take a look at those right here.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So one of the areas was the funding of loans continue to shift towards deposits. Now that's good news in the first quarter of 2024 because the average rate on deposits was 226 basis points lower than that of warehouse facilities. Warehouse facilities are money that comes from investors or lenders that SoFi uses to make loans, and SoFi typically has to pay higher rates on those funds versus the rates that it has to pay depositors on their deposits. So the more SoFi uses depositor money to make loans, the lower the cost of funding, and that allows SoFi a competitive advantage in the markets for making loans. Additionally, SoFi added nearly 622,000 members in the quarter, and total members reached over 8.1 million, up nearly 2.5 million, or 44% from the prior year. Now, if you'll recall, several years ago when I had been talking about SoFi stock, or when I begun talking about SoFi stock, I highlighted the big question mark between SoFi and traditional banks is the customer value proposition. How much do customers value the technology, the app, the website versus the physical branch, going into a location, having people to talk to, answer your questions, help you facilitate some transaction that you may not be aware how to conduct. So far, it seems like more and more so, people prefer the tech advantage, the better app, the better website over the customer service proposition of having a person to speak to. And that's going to determine a lot of SoFi's success because it's betting that people will prefer the branchless banking service, because having a branch, very expensive, right? Capital intensive. You got to have the location, pay for rent or lease expense, or buy that location. You got to supply that location with individuals that work there, and wages are rising more and more so. It's becoming more and more expensive to operate physical locations. And if customers show that they prefer this branchless banking experience, that's going to be great for SoFi longer term, because the money that it could be spending on physical locations, it can spend on offering better service to customers via the app, via the website, and maybe pay higher interest rates to customer deposits as it's doing now, because it doesn't have to spend so much money on physical branches. Now, physical branches over the years have become worse and worse in terms of the customer service they offer. They're supplying fewer windows open. The few times I've had to go to my local bank branch, it's been an awful experience. The lines are long. The employees are not informed on the bank's products. The outside, where they have merchant bankers and where they have more informed bankers, they're usually empty. You don't see people there working. And so that experience has worsened over the years as banks have tried to cut costs and serve their customers with fewer employees. And so more and more so, it's leaning towards in favor of SoFi over the years, and that's been great news. Now, another area I had been paying close attention to with SoFi, and that's going in the right direction, is the proportion of loans in the different categories. So personal loans, student loans, and home loans are the three categories SoFi operates under. Home loans are still such a small portion of its overall business. It's primarily personal loans. And the argument I had been making is I would prefer SoFi move more towards student loans and home loans, because personal loans are more risky. And that's what I saw in the latest quarter. You can see here the total fair value of loans: 15 billion in personal loans, 6.8 billion in student loans, and only 59 million in home loans. SoFi did make an acquisition in the home loan segment, so that's helping it grow faster there. And I'll show you the growth rates in a little bit. But you could see here a breakdown of personal loans and student loans and the default rate compared to the coupon rate on each of these. So let's start with personal loans. The weighted average coupon rate is 13.8%, but the default rate is 4.8%. Compared to student loans, where the weighted average coupon rate is 5.6%, but the default rate is only 0.6%. So with personal loans compared to student loans, you get an 8x more default than student loans. So people default on their personal loans 8 times more frequently than student loans, but investors and SoFi generate a little over 2.5 times the coupon rate. So to account for the higher defaults, SoFi charges higher rates on personal loans than they do on student loans. But in my opinion, the higher coupon rate doesn't justify the amount of higher default that you're getting with personal loans. You're getting 8 times more, and you're only getting 2.5 times more interest to compensate you for the higher defaults. What makes matters worse is SoFi doesn't really have data during a recession. SoFi's been operating its lending business mostly through an economic expansion where the economy's been adding hundreds of thousands of jobs seemingly every quarter, every month. What's going to happen during a recession? These personal loans, the default rates on personal loans explode during recessions, because if you lose your job and you don't have enough money to pay all your expenses, one of the first things you will default on is your personal loan, because those are not with any collateral. Right? You're not going to default on your car loan or your mortgage, because if you default on those, they'll get repossessed. They'll take away your home and they'll take away your car. But if you default on your personal loan, you're not losing anything other than your credit score. So that's going to be the first thing you default on. And during recessions, these have the highest default rates. And so I was happy to see that SoFi in the latest quarter, growth came more so from the other segments. So here's that data. Personal loan originations in the first quarter were up 11% year over year and 2% from the previous quarter. Student loans, however, were up 43% year over year and declined 5% sequentially. Home loans were up 274% year over year and up 9% sequentially. So overall, the company made more loans in other segments versus the personal loan segment in the most recent quarter. Growth came from other segments instead of the personal loan segment. And that's what I want to see from SoFi going forward. I want to see more of its loans coming from the student loan segment and even more so from the home loan segment. The home loan segment, in my opinion, is the most lucrative, especially if you're conservative with the lending and you require 20% down payments and you have high credit score borrowers. You're not really risking very much because you can foreclose on the homes that people default on, and you're going to get back your collateral. You're going to get back your principal amount, whereas personal loans are the riskiest in the category. So I like that SoFi has shifted more so towards these other segments, and that's really good news for SoFi stock investors in the long term. Did you know that over 90% of the people that watch my channel are not subscribed? It'll really help support my channel if you hit that subscribe button. And oh, by the way, one of the benefits of being subscribed is that I take requests from subscribers more often than I do from non-subscribers. So if you prefer that benefit, please subscribe to the channel.